What if the metal everyone thinks is available is already spoken for? What if the real story isn't the price on your screen, but what a guess left behind the vault doors? Over the past few days, quiet inflows have been stacking up, and the numbers now point to something most investors haven't fully processed yet. If such a large share is already tied to funds, then the next question becomes uncomfortable. How much is actually left for new demand? Because when supply looks deep but turns out to be thin, markets don't move slowly, they move suddenly. And if that shift is already beginning, the next 24 to 72 hours could tell us whether this is just noise or the early stage of a much tighter silver market than people expect. Welcome to Market Metal, where we break down what the data is really hinting at, calmly, clearly, and without the hype. If you find value in straight, easy-to-understand market warnings like this, consider subscribing, especially if you've been following markets for years and prefer signals over noise. And before we go further, tell me in the comments, which city or country are you watching from today? The signal. When ownership concentration becomes a market risk. In recent weeks, a quiet but important signal has started to appear inside the global silver market. It is not a signal driven by headlines or sudden price spikes. Instead, it comes from something more structural. Who actually holds the metal and where that metal is stored. For business leaders, investors, and young entrepreneurs who follow commodity flows, this shift is worth careful attention. The current discussion begins with a simple observation. A large share of the silver stored in London vaults is now reported as being held by exchange-traded funds, commonly known as ETFs. These funds are designed to give investors exposure to silver without requiring them to handle or store the metal themselves. On the surface, this seems efficient and modern. However, when ownership becomes highly concentrated inside financial vehicles, the structure of the market can change in ways that are not immediately visible. London is not a mining region. It does not produce silver. Instead, it functions as one of the world's main trading and storage hubs for precious metals. Large bullion banks and specialized security firms operate vault networks that hold metal on behalf of funds, institutions, and private clients. Because London is a terminal market, it acts as a central warehouse where metal can be moved, pledged, financed, or delivered against contracts. When inventory inside such a hub becomes tightly allocated, the flexibility of the system can narrow. To understand why this matters, it helps to look at how physically backed ETFs work. These funds typically purchase approved silver bars, often referred to as good delivery bars, and store them in recognized vaults. Each share of the fund is meant to represent a claim on a specific quantity of physical metal held in custody. For investors, this creates convenience. For the market, it creates a new layer of ownership that sits between the metal and potential industrial or institutional users. The key issue is not whether ETFs are legitimate. They are widely used financial tools. The issue is concentration. When a very large percentage of the metal in a major storage hub is already attributed to investment vehicles, the portion that remains readily available for new demand becomes smaller. This does not automatically mean there is a shortage. It does, however, suggest that the float, the metal that can move quickly between buyers, may be thinner than the headline inventory numbers imply. From a strategic perspective, ownership concentration has historically acted as an early indicator of market sensitivity. In many commodity markets, when inventories are widely dispersed across producers, traders, and industrial users, price movements tend to be gradual. When inventories become concentrated in fewer hands, even moderate shifts in demand can create faster reactions. This is because fewer decision makers control a larger share of supply. For entrepreneurs and business operators, especially those involved in manufacturing or technology, silver is not just a financial asset. It is also an industrial input used in electronics, energy systems, and specialized equipment. If the available pool of deliverable metal tightens, procurement timelines and hedging strategies can be affected. This is why understanding the structure of ownership is just as important as watching the price chart. Another factor that adds weight to the signal is the difference between reported inventory and accessible inventory. Public data may show large quantities of silver stored in vaults, but not all of that metal is freely available for immediate purchase. Some bars are allocated to long-term holders, some are tied to fund mandates, some may be pledged as collateral in financing arrangements. The headline number can therefore create an impression of abundance, while the portion that can actually change hands quickly may be much smaller. This distinction becomes clearer when examining how capital flows influence physical markets. When investment demand increases, funds may continue to acquire and lock away additional metal. Each new inflow removes a portion of supply from the active trading pool. Over time, this can reduce liquidity even if total reported stocks remain high. The system does not run out of metal, but it becomes less flexible. Market historians have observed similar patterns in other commodities. Periods of strong investment interest often coincide with tighter spot availability, higher lease rates, or increased reliance on logistics networks to move metal between regions. None of these developments necessarily indicate a crisis. They simply reflect the mechanics of supply, ownership, and timing. It is also important to note that London A&S Vault system supports many different participants at the same time. Bullion banks, funds, private investors, and industrial buyers all operate within the same infrastructure. When several groups draw from overlapping inventories, competition for specific bar formats or locations can increase. Even if total global supply is adequate, local bottlenecks can still appear. For decision makers, the practical question is not whether silver exists somewhere in the world. The practical question is whether it is available in the right form, in the right place, and at the right time. Good delivery bars, for example, meet specific standards that allow them to be used in institutional transactions. If a large portion of these bars is already held inside funds, sourcing additional units may require transportation, refining, or conversion from other formats. Each step introduces delay and cost. Another structural detail often overlooked is that silver does not typically benefit from the same type of official reserve support that gold does. Central banks rarely hold significant silver inventories. This means that in periods of strong demand, there's no large public stockpile that can be quickly lent into the market. The system relies primarily on private inventories and ongoing supply flows. From a strategic standpoint, this environment encourages closer monitoring of inventory distribution rather than price alone. Price can move for many reasons, including currency shifts and speculative activity. Inventory concentration, by contrast, reflects physical positioning. It reveals who holds the metal and how easily it can circulate. For young entrepreneurs studying market behavior, this moment offers a practical lesson in how financial structures interact with physical commodities. Modern markets are layered. There is the visible layer of prices and headlines, and beneath it, there's the operational layer of storage, custody, and ownership. Changes in the deeper layer often appear before major adjustments become obvious to the wider public. As the analysis of London's silver holdings continues, the central question becomes more precise. If a substantial share of reported inventory is already allocated to funds and long-term holders, how much remains accessible for new participants entering the market? The answer does not require dramatic assumptions. It simply requires careful accounting of where the metal sits and under what conditions it can move. This is why the current signal is best understood as a structural warnings rather than a prediction. Markets do not shift because of a single statistic. They shift when multiple constraints begin to align: ownership concentration, logistical limits, and sustained demand. When these factors appear together, sensitivity increases. Part 1 therefore closes with a measured but important observation. The silver market is not defined only by how much metal exists, but by how much of that metal is truly available. When a large percentage of a key storage hub's inventory is already spoken for, the margin for additional demand narrows. In such conditions, even routine capital flows can carry outsized influence on liquidity, pricing behavior, and procurement timelines. The next stage of the analysis must therefore move beyond headline vault totals and examine a deeper layer of the system: the difference between reported stocks and less visible custodial holdings, and how investment demand quietly reshapes what the market perceives as available supply. Reported versus unreported stocks, the hidden layer of bullion liquidity. After recognizing that a large share of London's vaulted silver is already attributed to investment vehicles, the analysis moves to a deeper and less visible layer of the market. The next question is not how much silver exists, but how much of that silver is truly accessible. In commodity markets, the difference between what is reported and what is actually available can quietly shape outcomes long before price charts reflect the change. Bullion inventories are generally divided into two broad categories. The first category is reported stock. This includes metal held by exchanges, exchange-traded products, and certain institutional holdings that publish regular updates. These numbers are visible, measurable, and often cited in market commentary. The second category is less transparent. It consists of custodial holdings that are not fully disclosed in real time. These can include metals stored on behalf of private institutions, wealth managers, family offices, or long-term strategic investors. On paper, the presence of large reported inventories can create a sense of comfort. The market appears well supplied. However, experienced operators understand that reported totals do not automatically translate into usable liquidity. Some of the metal is already committed to specific mandates. Some is allocated to clients who have no intention of selling. Some may be pledged as collateral within financing structures. The inventory exists, but it is not necessarily circulating. This distinction becomes more important during periods of rising investment interest. When demand strengthens, refiners and wholesalers typically become more cautious about releasing metal into open storage systems. Instead of increasing visible inventories, the flow of newly produced or recycled silver may move directly toward buyers who intend to hold it. As a result, reported stocks can remain stable while the accessible pool quietly tightens. The situation is further influenced by the behavior of the wealth sector. Institutional investors and high net worth participants often hold allocated bullion positions for long-term portfolio diversification. These holdings are usually stored in the same major vault networks that serve funds and trading desks. Because they are privately owned and not frequently traded, they rarely return to the active market. From a liquidity perspective, they function as metal that exists but does not move. When multiple groups rely on the same vault ecosystem, competition for specific inventory increases. Exchange-traded funds, private investors, and industrial users may all be drawing from overlapping sources. Even if the total quantity of silver appears large, the portion that can change hands quickly may be limited. This is why professional commodity desks track not only total stocks, but also the free float within those stocks. The concept of free float is simple. It refers to the metal that is not already tied to long-term commitments and can be delivered or reallocated without delay. In highly liquid markets, the free float is broad. In more concentrated environments, it narrows. When the float becomes thin, relatively modest capital flows can have a disproportionate effect on availability and pricing. Another layer of complexity comes from the nature of custody itself. Large bullion banks often act as custodians, while specialized security firms operate the physical vaults. This structure is efficient but interconnected. If several funds increase their holdings at the same time, they may all request additional bars from the same network of storage providers. The system is capable of adjusting, but it does not expand instantly. Logistics also play a quiet but critical role. Silver may exist in other regions, but moving it into an approved vault requires transportation, insurance, verification, and sometimes refining into the correct bar format. Each step introduces time. During periods of steady demand, these delays are manageable. During periods of sudden inflows, they can become more visible. The difference between visible abundance and practical accessibility has appeared in many commodity markets before. Energy, agricultural products, and industrial metals have all experienced moments when inventories looked sufficient on paper but were difficult to mobilize quickly. The lesson is consistent. Availability is not only about quantity, but also about location, ownership, and readiness for delivery. For business leaders who depend on reliable supply chains, this distinction carries direct implications. If accessible bullion inventories decline, procurement may require longer lead times or higher financing costs. Hedging strategies may need adjustment. Contracts that assume immediate availability could face delays. None of these outcomes require an extreme shortage. They arise simply from tighter operational margins. It is also important to recognize that strong investment demand can change the behavior of existing holders. When market participants believe that supply may become less flexible, they are often less willing to release metal back into circulation. This creates a feedback loop. Reduced circulation encourages more cautious holding, which in turn reduces circulation further. The process is gradual, but it can reshape liquidity conditions. Within the London Vault network, this dynamic is especially relevant because the city functions as a central clearing and financing hub. Metal stored there is frequently used as collateral for trades, loans, and structured transactions. When a larger share of that collateral is locked into long-term positions, the system's ability to absorb new flows becomes more sensitive. From an analytical standpoint, the situation does not require dramatic conclusions. The presence of both reported and unreported stocks is normal. The key question is how these categories shift relative to each other. When reported holdings grow quickly, especially inside funds that rarely release metal, the proportion of truly available inventory can decline even if total stocks appear stable. This is why experienced commodity analysts focus on trends rather than single data points. A gradual migration of metal into long-duration ownership structures can signal tightening conditions well before any visible shortage emerges. Markets rarely move from abundance to scarcity overnight. They pass through a phase where supply exists, but is increasingly spoken for. For younger entrepreneurs studying resource markets, this phase is instructive. It demonstrates how modern financial products can influence physical supply chains. Capital does not only affect prices, it also determines where materials are stored and how easily they can be accessed. Understanding this relationship is essential for anyone planning long-term operations that depend on stable inputs. As the analysis continues, another question naturally arises. If both publicly reported funds and privately held allocations are drawing from the same vault ecosystem, how diversified is that ecosystem in practice? Are multiple funds sourcing from independent pools of metal? Or are they relying on the same custodians and storage facilities? Answering that question requires mapping the broader network of silver-backed products and the institutions that support them. Because if several large vehicles depend on overlapping infrastructure, even moderate inflows across the system could translate into significant demand for the same physical bars. That possibility does not imply immediate stress, but it does suggest that the market ES margin for flexibility may be narrower than surface data implies. Part 2, therefore, closes with a measured but more pointed observation. The silver market's apparent depth is shaped by layers, reported stocks, private allocations, and operational logistics. When a growing share of inventory shifts into long-term or non-circulating hands, the remaining float becomes more important than the total headline number. In such an environment, the next phase of analysis must examine the full ecosystem of funds and custodians to understand how many different players are competing for access to the same underlying supply. The ETF ecosystem, a network, competing for the same physical supply. By this stage of the analysis, the focus shifts from inventory totals to the structure of the institutions that hold the metal. The earlier sections established that a large share of London S vaulted silver is attributed to investment vehicles and long-term holders. The next step is to examine whether these holdings are widely distributed across independent systems or whether they are concentrated inside a single operational network. At first glance, the market appears diversified. There are multiple silver-backed exchange-traded products operated by different providers, listed on different exchanges, and marketed to different investor groups. This variety creates the impression of many separate channels through which capital can enter the silver market. However, when the custody and storage arrangements are mapped carefully, a more concentrated picture begins to emerge. Most physically backed silver funds rely on a relatively small group of custodians, primarily large bullion banks, and a limited number of professional vault operators. These institutions provide the infrastructure required for secure storage, auditing, and settlement. The model is efficient and widely trusted, but it also means that many independent-looking products ultimately depend on overlapping physical resources. In practical terms, several funds may hold their metal within the same city, sometimes within the same vaulting network, and occasionally even under the supervision of the same custodial bank. Each fund publishes its own holdings and bar lists, yet the underlying storage environment is shared. From a systems perspective, this creates a hub and spoke structure rather than a fully distributed one. This distinction matters because shared infrastructure can introduce concentration risk. If investment inflows increase across multiple products at the same time, those funds may all request additional metal from the same custodial ecosystem. The demand does not arrive through a single channel. It arrives through many channels that converge on the same physical pool. The situation is comparable to several companies drawing water from the same reservoir. Each company operates independently, but the resource they depend on is common. As long as inflows are modest, the system functions smoothly. When inflows accelerate, the draw on the shared resource becomes more visible. Another layer of complexity comes from the use of sub-custodians. While the primary bullion bank may act as the official custodian for a fund, the actual metal can be stored across multiple third-party vaults operated by specialized security firms. This arrangement improves flexibility and geographic coverage. At the same time, it spreads the inventory across facilities that are still part of the same broader network. For analysts, the key question is not whether the metal exists, but how easily it can be consolidated, transferred, or delivered when multiple funds expand simultaneously. Physical silver is not a digital asset that can be moved instantly between accounts. It requires transport, verification, and sometimes conversion into approved bar formats. Each of these steps introduces friction. Transparency tools such as daily bar lists provide useful visibility into holdings. They show serial numbers, weights, and storage locations. However, these disclosures have limits. Reporting may lag behind real-time movements. Audit cycles vary between providers. Some facilities publish detailed data, while others provide only summary figures. As a result, the public can observe the structure, but not always the speed at which it changes. Despite these limitations, one pattern is clear. The silver ETF landscape is broader than any single flagship fund. Numerous products, across multiple providers, hold meaningful quantities of metal within the London Vault system. When their holdings are combined, the cumulative demand on the same infrastructure becomes significant. This broader view changes how inflows should be interpreted. A modest increase in one fund may appear manageable. Similar increases across several funds, occurring within the same time frame, can translate into a substantial requirement for additional bars. Because these products often seek the same type of good delivery silver, their sourcing channels overlap. Geography adds another layer to the analysis. Many of these funds are domiciled in different jurisdictions, some in the United Kingdom, others in Ireland or elsewhere, and they trade on various exchanges in different currencies. From a regulatory standpoint, they are distinct. From a physical custody standpoint, they may still rely on London as the central storage hub. This creates the appearance of dispersion while maintaining a core point of concentration. For institutional participants, this structure is not unusual. Financial markets often centralize critical infrastructure to reduce cost and increase efficiency. However, centralization also means that system-wide behavior can change quickly when multiple participants act at once. In commodities, where delivery depends on physical movement, such shifts are especially important. Another operational detail concerns bar format eligibility. Many funds are restricted by their prospectuses to holding specific types of bars that meet recognized standards. If a portion of total vaulted silver exists in other forms, smaller bars or coins, it may not be immediately usable for these products without refining or recasting. This reduces the effective pool of eligible inventory, even if total metal remains unchanged. From a strategic standpoint, the presence of many funds competing for similar resources does not imply instability by itself. It does, however, narrow the margin for unexpected demand surges. When several large vehicles share the same sourcing channels, the system must either draw from existing stocks, attract metal from other regions, or wait for new supply to enter the pipeline. None of these adjustments occur instantly. For business leaders observing the metals market, this interconnected structure highlights the importance of monitoring flows across the entire ecosystem, rather than focusing on a single headline product. Changes in secondary or lesser-known funds can still influence the availability of physical bars if they rely on the same custodial network. The broader lesson is that diversification at the product level does not always translate into diversification at the infrastructure level. Multiple brands, tickers, and jurisdictions may still converge on a common set of vaults, custodians, and logistics providers. When capital enters the system through many doors, but exits through the same warehouse, the warehouse becomes the critical point of sensitivity. As investment interest in silver continues to fluctuate, the operational question becomes more pressing. If inflows persist across several funds simultaneously, where will the additional metal be sourced in the short term? Will it come from existing vaulted stocks, from private holders willing to sell, or from metal transported in from other regions? These are not theoretical concerns. They relate directly to timing, cost, and market responsiveness. Even in well-supplied global markets, short-term availability can tighten if logistics and ownership structures limit immediate access to eligible inventory. Part 3 therefore closes with a focused observation. The silver ETF universe is best understood not as a collection of isolated funds, but as a network drawing from a shared physical base. When multiple participants depend on the same custodians, vaults, and bar formats, their collective behavior can amplify the impact of otherwise routine capital flows. The next stage of analysis must therefore examine the practical limits on sourcing additional silver, how quickly it can be moved, converted, and delivered when demand rises faster than the system's normal pace. Supply constraints, logistics, and the market's narrow margin for error. By the time the analysis reaches this stage, the question is no longer theoretical. If a large share of London AS vaulted silver is already attributed to long-duration holders and multiple funds rely on the same custodial network, the remaining issue becomes operational. How quickly can additional metal be sourced if demand continues to rise? In commodity markets, the difference between adequate supply and tight supply is often measured not in total quantity, but in response time. Silver exists in many places around the world, in mines, in refineries, in industrial inventories, and in private holdings. However, only a portion of that global stock is immediately deliverable into the specific vaults and bar formats required by institutional products. This distinction defines the market's short-term flexibility. Mining output, for example, cannot expand overnight. New production is tied to long development cycles, permitting timelines and capital expenditure decisions made years in advance. Even when prices rise, additional supply usually arrives slowly. Recycling can provide a faster response, but recycled metal must still be collected, refined, and cast into approved bar specifications before it can enter major vault systems. Each stage introduces delay. Logistics adds another layer of constraint. Moving silver between regions requires transportation, insurance, security coordination, and verification at both the origin and destination. In normal conditions, these processes are routine. During periods of elevated demand, shipping capacity, insurance costs, and scheduling can become limiting factors. Metal may exist elsewhere, but it is not yet where the market needs it to be. A further practical detail concerns bar eligibility. Many institutional vehicles require good delivery bars that meet recognized weight and purity standards. If a portion of total silver stocks exists in smaller bars, coins, or industrial forms, it cannot be used immediately without conversion. Refining and recasting take time and depend on available processing capacity. This reduces the share of global silver that can respond quickly to institutional inflows. Unlike gold, silver also lacks a large official reserve system that can act as a stabilizing buffer. Central banks rarely hold significant silver inventories. As a result, there is no major public stockpile that can be readily lent into the market during periods of strong demand. The system relies primarily on private inventories, ongoing production, and the willingness of existing holders to release metal. This structure does not imply fragility, but it does mean the market operates with a narrower margin for rapid adjustment. When accessible inventory is already committed and new supply requires time to mobilize, even moderate changes in capital flows can influence short-term conditions. These influences often appear first in subtle indicators. lease rates, delivery times, and regional premiums before they become visible in broader price movements. Another operational factor is the role of collateral. Silver stored in major vaults is frequently used to support financing arrangements, structured trades, and hedging strategies. When a larger portion of that metal is locked into long-term positions, the pool available for collateral substitution becomes smaller. This can increase the cost of short-term borrowing or require participants to source alternative assets. Industrial demand adds its own layer of complexity. Silver is used in electronics, energy systems, medical equipment, and specialized manufacturing. Many of these applications depend on consistent supply rather than opportunistic purchasing. If accessible inventories tighten, industrial users may shift from just-in-time procurement toward earlier contracting or higher safety stocks. Such behavior can reinforce the perception of limited availability, even if global supply remains sufficient over the long run. From a strategic perspective, the market does not need to experience an outright shortage for conditions to feel tight. Tightness often emerges when the time required to obtain material lengthens. A buyer who previously secured delivery within days may now wait weeks. A financing desk that once accessed collateral immediately may need to arrange transfers between facilities. These are operational signals, not headline events, yet they shape decision-making across the system. It is also important to consider geographic flow patterns. When demand strengthens in one region, metal may be drawn from another. This rebalancing can occur smoothly, but it depends on transport capacity and regulatory processes. If several regions experience simultaneous demand, the system must prioritize which flows move first. In such moments, location becomes as important as quantity. The absence of a central clearing authority for physical silver further reinforces the role of private coordination. Bullion banks, vault operators, refiners, and logistics providers must align schedules and resources to meet delivery needs. Their networks are experienced, but they are not infinitely elastic. When multiple requests arrive at once, sequencing becomes necessary. For business leaders and entrepreneurs studying resource risk, this environment highlights a practical lesson. Supply chains are not only about production volumes, they are about timing, format, and access. A commodity can be abundant in aggregate, yet constrained in its most usable form. Recognizing this distinction allows firms to plan procurement, hedging, and inventory strategies more effectively. Historical commodity cycles show that markets typically resolve tight conditions through one of several pathways. First, prices may adjust gradually to encourage additional supply or discourage marginal demand. Second, metal may be attracted from other regions as arbitrage opportunities appear. Third, holders who were previously inactive may choose to release inventory. Each pathway requires time, and during that period, sensitivity remains elevated. In the current structure, where multiple funds and private holders share the same vault ecosystem, the system's responsiveness depends on how quickly these adjustment mechanisms activate. If inflows remain moderate, logistics and existing stocks can absorb them. If inflows accelerate across several channels simultaneously, the need to source additional eligible bars becomes more urgent. This does not mean disruption is inevitable. Commodity markets are resilient and have navigated similar phases before. However, resilience does not eliminate friction. It simply manages it. The presence of friction is what creates short-term volatility and availability, financing costs, and delivery timelines. For decision makers, the most constructive response is not alarm, but preparation. Monitoring inventory distribution, lease rates, transport flows, and refining capacity provides early insight into whether conditions are loosening or tightening. These indicators often move before broader market narratives catch up. Part 4, therefore, closes the analysis with a disciplined conclusion. The question facing the silver market is not whether metal exists, but how quickly accessible, eligible metal can be mobilized when demand rises. With a significant share of key vault inventories already allocated and multiple participants relying on the same infrastructure, the system operates with a thinner operational buffer. In such an environment, even routine inflows can carry outsized influence on short-term liquidity, prompting the market to adjust through price signals, logistical shifts, or changes in holder behavior.